Greetings, everybody. This is Dr. Phil, and this is going to be a video on international trade. So let's go ahead and jump into it. So the first thing we'll talk about is imports and exports, probably terms that you've heard before. So we think of imports as goods and services that are purchased from foreign sources. So think about things that are coming into the country. America imports about $3 trillion worth of products from the rest of the world, and that's, of course, every year. And it could include, there's a lot of things it can include, but things like coffee, baseballs, steel, a big, sort of a wide cross section there. Things like travel, Air France, Mexico, if you basically, travel, to and from the US, on another country's airline. Um, Insurance, if it's underwritten by someone like Lloyd's of London, entertainment, anytime a foreign, movie that was produced in a foreign country. Together, our imports account for about 15% of US GDP, so a pretty sizable amount of GDP. Now, as far as exports go, we can just think of the exact opposite. So, exports are goods and services that are sold to foreign buyers. So, in 2020, America exported over 1.4 trillion of goods and nearly 700 billion of services. So, obviously, we're exporting actually exactly two times the amount of goods than we are services. So some examples could be farm products, machinery, raw materials. Again, think like a wide cross section of goods and services. Some examples of services that the US is exporting could be tourism, software, and insurance. And in this case, exports account for around 15% of total US output. So again, pretty sizable, pretty significant. So let's talk about the next thing. There's a logical kind of corollary to the import-export stuff is what we call the trade balance, or sometimes it's just called balance of trade. So a trade balance is the difference between exports and imports. So as it says, the little formula we got here, trade balance, you just take your exports, subtract your imports, and that's going to tell you what your trade balance is. Now, a trade deficit is the amount by which the value of the imports exceeds the value of the exports in a given time period, probably a year. So a simple way of saying that is if you're basically importing more than you're exporting, then you have a trade deficit. A trade surplus is the amount by which the value of exports exceeds the value of imports, again, in a given time period, and again, probably a year. So think the trade surplus is you've got more, you're exporting more than you're importing. So any imbalance in US trade must be offset by reverse imbalances elsewhere. So like if we have, say, like a trade surplus with Canada, or the UK, then obviously they must have a trade deficit, and vice versa. So both merchandise, goods and services are traded between countries, obviously. The US typically has a merchandise deficit and a services surplus. So when combined, if we combine them, that's what we're showing you down here at the bottom. We have an overall trade. I say we as in the US has an overall trade deficit, which remained in 2020. So you can see here, like goods. Look at the exports 1435, imports 2351. So obviously there's a big surplus, a bigger deficit, excuse me. That's hence why that's negative, that 916 in parentheses. For services, 692 exported out, 458 coming in, so we have a service surplus. So if we sort of net those goods and services, deficit and respective services surplus against each other, then we get a total trade deficit of 682. So let's talk about bilateral trade balances. So the US had a huge trade deficit with China and Mexico, which makes sense because you think about all the stuff that we buy that's made in China. The US had small trade surpluses with Hong Kong, Brazil, and the United Kingdom. International trade is, of course, multinational, with surpluses in some countries being offset by trade deficits elsewhere. So sort of think of it like wherever there's, a gain in the sense of a surplus, there's got to be an offsetting deficit in terms of another country has got to have a deficit, which of course would be a loss to them. So what about the motivation to trade? So when countries trade goods and services, they are specializing in production and then trading for other desired goods. It speaks to a little bit about Adam Smith's sort of, competitive and comparative advantage. If you've ever read up on that, if you haven't, I encourage you to. It's very, very interesting stuff. A good book I recommend is called The Wealth of Nations, which will help you understand that a little bit better, a little bit more. So specialization increases total output. So countries that trade can together produce more total output than they could in the absence of trade. The gain from trade is increased world output and a higher standard of living. So production and consumption without trade. Production possibilities are the alternative combinations of goods and services that could be produced in a given time period with all available resources and technology. Consumption possibilities are the alternative combinations of goods and services that a country could consume in a given time period. And again, notice it says could in both the production possibilities explanation and also the consumption possibilities explanation. It's saying could because some of this is, of course, theoretical. Now, in the absence of trade, a country cannot consume more than it produces, obviously, right? Because it can't get it. If it's not coming in from anywhere else, then the maximum it can consume, excuse me, is of course what it produces. We can use trade to break the link between production and consumption. So with trade, a country's consumption possibilities can exceed its production possibilities because we can kind of make that up by bringing stuff in from, from the outside, other countries, of course. The gains from trade are due to specialization in production, and the increase in the combined output of both countries is, of course, the gain from trading. So you may have heard the term opportunity cost before. I was just talking about briefly about comparative advantage alongside competitive advantage, of course. So the first thing we'll talk about here is opportunity cost. So this refers to the most desired goods and services that are foregone in order to obtain something else. So a good way to think about opportunity cost is like the cost of the next best alternative. That's a good way to think about it. Like if you pick A, then you gave it B. And maybe you like B too, but you couldn't have them both, so you picked A, so your opportunity cost was B, right? Comparative advantage refers to the ability of a country to produce a specific good at a lower opportunity cost. Think about comparing to than its trading partner. World output, and thus the potential gains from trade, will be maximized when each country pursues its comparative advantage. It's like saying, okay, if you're good at like making something, and you have a lower opportunity cost associated with that, then you should do that. And then the odds are another country has that same thing, but for a different product. So, country A makes widget A, country B makes widget B, and then we sort of trade back and forth. Now, absolute advantage refers to the ability of a country to produce a specific good with fewer resources per unit of output than other countries. So absolute advantage should not alter our production and trade decisions. All we really care about are opportunity costs. Again, think about, what's the cost of the next best alternative and what we have to give up in order to get more of a desired good. So terms of trade, this refers to the rate at which goods are exchanged. So the amount of good A that is given up for good B in trade. So a country will not trade unless the terms of trade are superior to domestic opportunity costs. So the terms of trade between any two countries will lie somewhere between their respective opportunity costs in production. And the terms of trade will depend on the willingness of market participants to buy or sell at various prices. So if demand is increased in, say, country A, then country B may be willing to supply more of them, so on and so forth. All right, let's talk very briefly about protectionist measures. Let's just talk briefly about this. So on a microeconomic level, there are gains and losers from international trade. Exports represent increased jobs and incomes for other industries. Producers and workers in export industries, of course, gain from trade because the demand from overseas is keeping them basically employed in a sense. Imports typically mean fewer jobs and less income for some domestic industries. So think about it like if they're importing something from, like if the US is importing, say, steel from Canada, then the US doesn't need as many steel workers. That would be an example. So workers and producers who work in import competing industries have an economic interest in restricting trade. So like if you're the US steel worker, right, you don't want them to be allowing Canada to bring in steel, right? Because that might cost you your job. It's a good way to think about it. So thus trade not only alters the mix of the output, but also redistributes income from import competing industries to export industries. So what are some barriers to trade? So those with microeconomic losses push policymakers to restrict trade. And there are really three main kind of tools, policy levers by which policymakers can do that, can affect that. The first one is, and we'll talk about all these briefly as well in the preceding slides. The first one is tariffs. The second one is quotas, and then the third is what we call non-tariff barriers. So what is a tariff? So the best way to understand a tariff is a tax or duty imposed on imported goods. So tariffs reduce the flow of imports by raising import prices. So, again, if the US is bringing in, say, Canadian steel, then they'll put a tariff on, say each ton, say metric ton or whatever of steel, makes it more expensive. So currently, there are tariffs on over 10,000 different products, nearly 50% of all US imports. So a tariff on imported goods makes them, think about the example I just gave you with the steel coming, the Canadian steel coming into the US. Obviously, it makes it more expensive to domestic consumers and also means it's less competitive with domestically produced goods. So it kind of gives the companies and the workers here in the US, it's kind of helping them out because it's making them more competitive. Tariffs can create winners. So in this case, the winners would be the domestic producers in import competing industries. So think about like the US steel workers in the example I just gave you. They're now more competitive against their Canadian counterparts. So thus you could say they're the winners, if you will. And then tariffs also create losers. So domestic consumers, of course, have to pay higher prices. So think about the people in the US, companies, individuals that want to buy steel, they have to pay more for it. Foreign producers, of course, will lose business. So, like the Canadians, for example, they could lose business. And then world efficiency is, of course, a loser too, because trade is ultimately reduced. All right, let's now talk about quotas. So quotas are a limit on the quantity of a good that may be imported in a given time period. So quotas, like all barriers to trade, reduce world efficiency and invite retaliatory action. So, if country A puts a quota on so and so, then, country B may do the same thing. And it doesn't really help either of them. Quotas are a much greater threat to competition than tariffs because quotas preclude additional imports at any price. So once you hit, say, a quota of 100,000 units a year, you can't go over that. It's done. You can't send any more, regardless of how cheap it may be. So approximately 12% of our imports are subject to what we call import quotas. All right, let's talk about exchange rates. So this is probably a term you've heard of before. If you've taken a previous, maybe a micro or macro economics class, you've probably learned a little bit about exchange rates. So as long as each nation has its own currency, every trade will require use of two different currencies at some point. So an exchange rate is the price of one country's currency expressed in terms of another country's currency. So for example, if a dollar exchanges for 2 euros, then you could say that a euro is worth 50 cents. So exchange rates are a critical link in the global pricing of goods and services. Whether an imported good is expensive really depends on two factors. One, foreign price of the imported good, and two, the dollar price of the foreign currency or the exchange rate. So the formula we would use to figure this out, we would say the dollar price of the imported good is equal to the foreign price of the good times the dollar price of the foreign currency. And that would typically be done using what's called the spot rate, i.e. the rate that it's worth today. So whenever exchange rates change, which of course they do constantly all the time, so do the global prices of all imports and exports. Currency appreciation is an increase in the value of one currency relative to another. And conversely, currency depreciation is a decrease in the value of one currency relative to another. If the value of a nation's currency declines, or we could say depreciates, then its exports become cheaper, and of course, its imports become more expensive. And China's been very good at that, by the way. So, like other market prices, an exchange rate is determined by, like most markets, supply and demand. So, foreign currency is demanded by, of course, US travelers abroad, US consumers buying foreign exports, and then US investors in foreign markets. So foreign currency is supplied by foreign consumers buying US products, kind of the reverse of the previous three we just talked about. So foreign currency is supplied by foreign consumers buying US products, foreign travelers visiting the US, think about the tourists that come here, they need dollars to spend, and then foreign investors in US markets. So the intersection of the supply and demand curves establishes the equilibrium price of the foreign currency, i.e. the prevailing exchange rate. All right, so let's talk a little bit about the euro market. So exchange rates change when either the supply of or the demand for a currency shifts. So for example, if the demand for euros increases and shifts to the right, then its value will rise or appreciate. So a euro appreciation would make European goods more expensive for Americans because then it would take like more dollars to buy the same amount of euros. But it would also make American goods cheaper for Europeans. So that'd be the time if you're European to come over here, start a business, go on vacation, because your money would kind of stretch further in that sense. So there are always winners and losers when exchange rates change. All right, so in this video, here's what we summarized. We talked a little bit about US trade patterns. We talked about things like quotas. We talked a little bit about embargoes. We talked about tariffs. We talked about trade surpluses and trade deficits, obviously in the form of trade patterns. We explained how trade increases total output. We explained how the terms of trade are established. We discussed how trade barriers affect market outcomes. And we also talked a little bit about how policymakers can adjust some of that. And finally, we described how currency exchange rates affect trade flows. So as always, thank you for watching, and I will see you in another video.